And you'll see where I did that circle on this slide. That's because the 50-day moving average, which we've been talking about this quite a bit, the 50-day moving average crossed below that 200-day moving average. And that is a technical bear signal. Here, gold and silver are the canary in the coal mine, and the canary is screaming because it's about the paper market cracking. I love this slide, and I had to use this slide because what does it say? This doesn't seem like a store of value. How are we supposed to trade this? However, what I liked the best was a 12-year high in bar and coin buying, because that's the public. So the central banks kicked this off. They've been buying since 2005, but the public is now transitioning. This past weekend, I looked at it and it was really interesting. I was looking for what people were searching the most, and millions of people went searching not for entertainment and not even for distraction, but for answers. They were looking for about what was going on with the gold and silver volatility, with crypto crashing, with bank safety, with inflation that won't go away, with the Fed losing control. And quite honestly, the reason why I read this first is because this is where it stems from. Why? Because the system is based on constantly compounding debt. And if you have a problem growing debt, you have a problem growing the fiat currency to stimulate the system. So that's why I brought that up first. But let me show you those signals, because it's showing us that that confidence is cracking, and the public, well, we can feel it. Because before a system breaks, we get a warning. Before the markets move, fear moves first. And right now, the world is asking the same question. Is my money safe? But you're talking about your fiat money that's in the system, and I can tell you right now, no, it's not safe. But what they don't realize is that these searches, they're not about the markets at all, really. They're about that first domino to fall, the one that falls really quietly. You can't even see it before the rest fall quite loudly, like we've been seeing over the last couple days. This is when the illusion starts to fade. The moment when systems reveal their weakness. And this is the moment when preparation becomes power. And that's what we have to do. That's what this is all about. My personal goal is to translate this financial noise into understandable language so that you can make educated choices that puts your best interest first. So let's move on so I can show you the first domino to fall was Microsoft. On January 30th, if you haven't noticed this yet, one of the most stable mega caps gapped down 11%. That's actually not normal. That's a collateral event. And you'll see where I did that circle on this slide. That's because the 50-day moving average, which we've been talking about this quite a bit, the 50-day moving average crossed below that 200-day moving average. And that is a technical bear signal. Okay? So look at that gap down, because that then triggered the next piece, which is Bitcoin, which has already been in a bear market.
Financial crises rarely begin with a dramatic collapse. They start quietly, with uncertainty. Before stock charts break down, public psychology does. One of the first visible cracks came when major technology stocks showed technical weakness. A key example was a large cap leader experiencing a sharp gap down after its shorter-term trend line crossed below its long-term average. A classic bearish signal. Soon after, cryptocurrencies followed. Assets like Bitcoin, which often thrive in abundant liquidity, tend to weaken when credit tightens. When speculation fades, markets rotate towards certainty. The pattern is familiar. As liquidity drains, the most confidence-dependent assets feel pressure first.
Here, gold and silver are the canary in the coal mine, and the canary is screaming because it's about the paper market cracking. I love this slide, and I had to use this slide because what does it say? This doesn't seem like a store of value. How are we supposed to trade this? Gold and silver are not a trade. The paper market's whipsawing 200 points one way or the other. That is about a trade and paper, and it's a trading market. The physical market is way different. It doesn't move that fast. It can't move that fast. And volatility in metals isn't really about the metals. It's about that paper market cracking. And when the derivative structure wobbles, and remember, derivative is just a big unsubstantiated bet. You can't convert it into the underlying. But when the derivative structure wobbles, it's this physical market that reveals the truth. Volatility is not risk. Counterparty exposure is that risk. And the physical market, well, it's told in a very different way, and it's showing a different story that started in 2025, right? When we were transitioning away from the paper markets into the physical markets dictating everything. Gold's record run in 2025 was not speculative. It was structural. We've talked about it throughout the year. Jewelry volumes fell 18% because prices rose, but spending hit $172 billion. Consumers did not walk away. They shifted how they buy gold. China is a great case in point, and so is India, because people move from jewelry to bars, coins, and even ETFs, which is not gold. That's what Wall Street wants you in because they can still control it. But the physical metal in your possession in any way, that's gold really returning to its monetary roots. But we also saw a massive east to west divergence. Western investors, like here in the US, they bought ETFs, while Asian buyers, especially in China, they bought the physical metal. Well, that's because the US has been used to those contracts dictating price. But what we're seeing is that breaking down. China's bar and coin demand broke the 2013 record for the first time ever. You saw bar and coin demand surpass jewelry consumption.
Crypto markets have historically acted as a pressure valve for excess liquidity. When money is plentiful, risk-taking flourishes. When conditions tighten, that excess drains quickly. Recent volatility has highlighted how far prices can fall when retail enthusiasm retreats. Unlike tangible assets, speculative instruments rely almost entirely on belief. That makes them powerful in expansions and fragile during stress. Meanwhile, artificial intelligence stocks and other high-growth sectors have also seen traders reduce exposure. These shifts reveal a domino effect. Once one risk asset falters, others often follow. Liquidity, not headlines, connects these moves. And liquidity appears to be changing direction.
But central bankers knew it back then. And today, they're buying more gold than at any time in modern history. So let me show you what that looks like. Because what you're looking at here are a bunch of central banks, and those blue lines, 22 institutions reported an increase in their gold reserves around a ton or more during 2025. And you already saw how much they've been accumulating. And yet, like I said earlier, demand actually set a fourth quarter record, but a lot of that demand actually came from the public. So the public is noticing that there is a problem here. ETFs inflows, well, I think that this is interesting because this is one way that Wall Street can control the visible price, because an ETF, all you have is a share of a trust. And the underlying gold and or silver that supports that, you have no access to. But Wall Street can decide to buy the ETF and push the spot price up, or sell the ETFs and push the spot price down. It's a tool. However, what I liked the best was a 12-year high in bar and coin buying, because that's the public. So the central banks kicked this off. They've been buying since 2005, but the public is now transitioning.
While speculative assets wobble, precious metals are flashing a different signal. Gold's recent strength has not been driven by jewelry demand or short-term traders alone. Instead, structural buying has emerged, particularly from central banks. For more than a decade, monetary authorities have quietly accumulated gold reserves, reversing decades of selling that dominated the 1990s. In 2025, global central bank purchases remain near record levels. At the same time, Asian demand for physical bars and coins has surged, with China and India leading accumulation. This shift suggests gold is being treated less as a trade and more as a monetary anchor.
Silver is the warning. Silver, and here it was. This was the beginning of January. Silver is now a strong buy, the highest lease rates since 2008. So what we're seeing here is the cost to borrow silver or to lease silver in times of stress spikes. And the timing of these spikes tell this story, because short-term silver lease rates hit their highest level since 2008, and both of these levels, which were in October of 2025 and then just recently, both of them are significantly higher than the lease rate premiums in 2008. What is that telling you? They want you to think everything is hunky-dory, that everything is just fine. But silver is the fuse. And what silver is telling you, even in these paper contracts, is that confidence is declining. And this is tremendous for you to know, because when confidence falls, well, what do? Exchanges intervene. And let's see, here it is. Market intervention. Surging silver and gold slide after the CME, and I did a video on this, raises margin requirements, which means that you have to come up with more collateral to borrow, which both of these, between the lease rates and the margin rates, that makes it more expensive to speculate. When you have the physical metal in your possession, you're not speculating. You're holding something with no counterparty risk. But all of this other stuff runs tons and tons of counterparty risk. So it was in, and this is really important, December 20, let's see, I think that's 29th of 2025 was when they did their first margin hike, triggering an immediate sell-off. Silver fell about 8% and gold about 5% on that Monday after they raised the rates. But that wasn't enough. Why not? Because guess what? They did it again on December 30th to the 31st. They raised the margin rates again, and again in January, just recently, on the 31st again. 3 hikes in 1 year. The first one alone was massive. 33% for gold and 36% increase for silver. That's massive. And the CME rarely raises margins twice in 1 week, unless that volatility is extreme and they are extraordinarily vulnerable.
Silver often amplifies financial stress signals. Recently, silver lease rates, the cost to borrow the metal, spiked to levels not seen since the 2008 financial crisis. Rising lease rates typically indicate tight physical supply or heightened demand for delivery. At the same time, futures exchanges increased margin requirements multiple times within weeks, making it more expensive to speculate. Historically, rapid margin hikes occur during periods of extreme volatility or systemic vulnerability. These interventions can temporarily suppress price surges, but they also reveal underlying strain. Paper derivatives may dominate short-term price swings, yet physical demand continues to quietly tighten conditions beneath the surface.
This, the 29th, the 30th, and 31st, this was a double hike event. What does that tell you? Because that tells me panic. That's what that's telling me, and that's what it should be telling you, because we've been talking about it all year. This shift is not completed yet, but I think we're at a very interesting part of this shift, and the shift I'm referring to is the physical metals dictating the markets, because we've certainly seen the premiums and talked about the premiums to buy the metal in other parts of the world, right? And the market reacted exactly as you would expect. What happened? Oh, I want to show you this too. This is from the FDIC's most current, so third quarter of 2025, gold and silver derivatives in the FDIC insured banks. And I circled 2025 so you could see how much more banks were trading gold and silver. Contracts, not the physical, the contracts. So that is an easy way for them to actually control the price that you see. And here's the market reaction. And actually, I noticed that one of the questions was about support and resistance, but on Friday, you saw silver make a major dumperooski, right? Now, let's go over the terms that we've been talking about for quite some time, because Friday's drop didn't change that trend. And actually, any of the drops, well, today, everything is spiking up. But yesterday, there was even another drop in spot gold contract. But even that did not take it out of that overbought position. Remember, we've talked about this right along. Remember, that does not mean overvalued. But overvalued means that the fundamentals don't justify the price, but that's not really what's happening right now. The fundamentals are very solid in both gold and silver. So let's take a look at it, because on that particular day, spot silver, and there's your 50-day moving average that we talk about, and there's the 200-day moving average that we talk about. So where are they? Well, at the end of Friday, you still had the 50-day moving average at almost 15%, and the 200-day moving average at 75%, keeping in mind that 10% is a lot. I don't really care if it pulls back.
Despite sharp pullbacks in futures prices, gold and silver remain elevated relative to long-term trend averages. Technical corrections in paper markets do not necessarily reflect weakening fundamentals. Instead, they may represent repositioning during a broader structural shift. For decades, derivative markets largely dictated visible prices. However, sustained central bank accumulation and strong global physical demand suggest a gradual transition toward tangible ownership influencing valuation. Whether or not a full crisis unfolds, one reality is clear. Trust is no longer automatic. In uncertain periods, capital historically gravitates toward assets without counterparty risk. The question investors now face is not timing, but positioning.